Hello, I'm Bernard Hickey with the Daily Briefing from interest.co.nz. Today we'll look at the latest report from the receivers for Numeria Finance and find out how much investors might get back. We'll work out just why the New Zealand and Australian dollars are so strong at the moment, and we'll find out how the slow collapse of the world's biggest monoline bond insurers is finally hitting our banks directly. Firstly, we check out the latest receivers report into the recovery of cash from the winding up of loans at Numeria Finance. Receivers at Korda, Mentha, Grant Graham and Brendon Gibson have come up with an early estimate of how much debenture holders in Numeria might get. And unfortunately, the news is not good. Initially, the receivers were quite confident about the loan book of around 6.9 million and talked about strong cash flows. But they've had a closer look and they've found that a third of the loan book is now in arrears. Graham and Gibson now say holders of $6.7 million worth of debentures in Numeria will initially get back between 38 and 51 cents in every dollar. They say another 19 cents is possible if they win a dispute with the first receivers of Capital and Merchant who bought Numeria before they both went into receivership. This number brings the current tally of expected losses from finance companies to $748.7 million. That's out of a total of $1.9 billion stuck in debentures in the 14 companies that have collapsed since 2006. Now for a look at why the New Zealand and Australian dollars are doing so well against the US dollar and what that might mean for interest rates here in New Zealand. The big news yesterday fits into that category of a butterfly flapping its wings in the Amazon basin and setting off a chain of events globally. The news did actually come from Brazil too. On Monday, the biggest steelmakers in Korea and Japan agreed to a 65% increase in the price of iron ore supplied by Brazil's biggest iron ore producer. 65%. So what, you might ask? This sets the benchmark now for negotiations going on between Australia's biggest iron ore producers, Rio Tinto and BHP, and China's big steelmakers. This is great news for the Australian economy and, not surprisingly, its currency. The Australian dollar jumped to a 4-month high of 91.3 US cents overnight. That dragged the New Zealand dollar up to 91.3, just below a 7-month high. Our currency tends to get lumped in with the Australian currency as sensitive to commodity prices. Now that's not completely untrue, although our commodities are quite different from the Australians. Our cash cows are actually cows, whereas the Australian cash cows are holes in the outback. And dairy prices have been stable to falling in recent months. But the key thing for interest rate watchers is this is great news for demand and spending in the Australian economy, which is the biggest buyer of our exports. Reserve Bank Governor Alan Bollard has said he is watching Asia and Australia closely for any signs of overheating, and the Reserve Bank of Australia is thought likely to hike official interest rates in a couple of weeks' time. Bollard is due to make his rates decision on March 6. He's expected to keep rates on hold, but has little room to cut them anytime too soon. And finally, a quick look at the monoline bond insurance crisis I've been warning about for weeks. It's now hit one of the banks in our part of the world. ANZ has had to put aside $200 million just in case a bond insurance deal it has done goes sour. Investors slammed ANZ's share price after the shock announcement. This is all because of a bunch of previously low-profile insurers of bonds and fancy credit derivatives have taken heavy losses since the subprime mortgage crisis ripped through global credit markets midway through last year. So-called monoline insurers such as NBIA, FGIC and AMBAC, remember those names, face credit rating downgrades that will force banks to write down the value of bonds and other derivatives they own that are insured by these monoline insurers. The crisis is now at the stage where these insurers are splitting themselves up into good insurance companies, insuring safe local government bonds, and bad insurers of these complex credit derivatives. The banks hate this idea because it means they will almost certainly have to launch into a new round of asset write-downs that will force them to raise yet more cash to bolster their balance sheets. Now, ANZ is nowhere near the point of having to raise cash from shareholders, but it can't be ruled out for a few of those such as Citigroup, UBS and Merrill Lynch, who have already had to raise billions from rich Arab and Asian investors. As we said before, when the butterfly flaps its wings in some previously unknown part of the jungle, the ripples eventually end up on New Zealand shores. I'm Bernard Hickey from interest.co.nz. Catch you on Wednesday.